Many people have lost money this year, but the surprising thing was that bonds added to the losses rather than reduce them as usual. Now that's created some unpleasant surprises for people with supposedly safe life strategy funds, for example, but also two-fund portfolios such as mine, which just mix global equity and global bonds. So why is that? And is the stock and bond portfolio now broken forever? This video is sponsored by NordPass, which lets you store, create, and use your passwords across multiple devices. So let's look at whether the bond and stock portfolio is broken or dead in a bit more detail. This is the worst year for bonds ever. So in these two panels beside me, you can see the US 10-year Treasury total real annual return. And this goes all the way back to 1872. So it's data from Robert Shiller. And in the bottom panel, you can see the same thing for equity. Now this year, notice the equity loss and the bond loss is roughly the same, 24% for both of them. And while this 24% loss for equity isn't a huge one by comparison with history, you can see 2008 was considerably bigger. For the bond panel, you can see that this is truly the worst one-year loss by some degree. Now, if you mix your bonds and equity to reduce the risk of your portfolio, that usually works as a strategy. So this is the return of a 60% stock, 40% bond portfolio going back over that period of time. And what you can see very clearly is that there have only been 3 events when the annual loss has exceeded 20%. And 2022 is one of those events over a 150-year period. The last time this happened was in 1974, where the loss was about the same, and the time before that was 1917, where the loss was even bigger. So although this loss seems to be catastrophic for people who thought they had a safe portfolio, you can see that once a generation, this 60-40 portfolio loses big. Because of that bond loss, it's become more difficult to answer a really simple question, like what is the safest life strategy fund? Now, in one of the first videos I made on YouTube about investing, I looked at the 5 life strategy funds, and what I like about them is that they're graded according to your risk appetite, but also by your investor objectives. In other words, how long are you going to be invested for before you'll need the money? If it's only going to be 3 to 5 years, you'd buy a life strategy fund on the lower end of the risk spectrum. But if you're going to be invested for 10 or more years, then you'd go for the higher risk portfolios. And the way you increase the risk of your portfolio, but also its return, is to increase the amount of stocks in it. So the lowest risk portfolio is Life Strategy 20. That's because it contains 20% stocks or equities and 80% bonds, which are supposed to be safe. Then if we dial up the risk, we get to Life Strategy 40. Then we get to the most popular fund, which is Life Strategy 60, which is 60% stocks, 40% bonds. Then Life Strategy 80 and Life Strategy 100, which is 100% stocks. And if, like me, you played Doom as a young lad, then you'll know about these 5 different levels on Doom. So Life Strategy 20 is like I'm Too Young to Die, and Life Strategy 100 is a little bit like Nightmare Mode. Now, one of the things I don't like about life strategy funds is they have a huge UK overweight. So I've come up with my own version of life strategy with just 2 funds in it. Now, obviously, the returns won't be exactly the same as life strategy, but just to show you what I mean, here I've got a 60% S&P 500 and 40% US Treasury fund. That's shown in red. And like life strategy, I haven't hedged the S&P 500. So that's expressed in sterling. And this has actually benefited from sterling weakening, certainly over the course of this year. Whereas the US Treasury fund, the bond component, is currency hedged, just like it is for life strategy. Now, the returns aren't exactly the same. You can see they're quite different. In fact, I have made a video about copying the returns as closely as possible, and it takes more than 2 funds. But what I like about the 2-fund approach is that it's very simple. If I reallocate from equity to bonds, I just sell some of one fund and buy the other. And I always know exactly what's going on with the portfolio because it's so simple. So what I'm about to say about life strategy applies equally to one of these 2-fund portfolios. The idea is exactly the same. You hold your equity to give you your long-term return, and you hold the bonds to mitigate the losses when equity does occasionally crash. At least that's the hope. Now, before I go on to talk about why bonds are sold off this year so much, but also what it means for the future, here's NordPass. Now, I use multiple accounts across multiple platforms because I have to try stuff out for the people who watch this channel. But also, I think many people now use multiple platforms, perhaps as a way to mitigate their risk. And they have to keep their passwords absolutely secure. Now, you can't rely on writing it down on a piece of paper. That's very risky if someone finds it. So many people use password managers such as NordPass. So here's what the application looks like on a laptop. It also works on mobiles, and you can use it across up to 6 devices. And it shares the password amongst those 6 devices seamlessly. So if you add a password on one, it's visible on the other. Here's what it looks like on your desktop, and yes, there's a native version that works on Linux, so I'm very happy with it. And of course it works under Windows and on Macs. So let's say I wanted to open up Twitter using my NordPass password, I could just click on the launch button here, and here it is. It's really that easy. And you can also get a browser plugin so that it automatically detects when you're trying to open a website and it'll suggest your password. And that works just as easily on your mobile device as it does here on a desktop. Viewers of PensionCraft get an exclusive deal where you get 4 additional months for free, and you can claim that by going to nordpass.com/pensioncraft, or just use PensionCraft, the name of our channel, at checkout. You'll also find a link to that in the description below. This is what the offer looks like from that link, and if you click on Get NordPass Now, here's the offer. You pay just 87 pence a month, and that's for the 2-year plan. That's a saving of 56%, but if you don't like it, there's a 30-day money-back guarantee. So why was this time different? Why didn't bonds hedge stocks? What I've shown here are the drawdowns. That's the biggest falls from the previous all-time high for the LifeStrategy 100 fund. The biggest of these falls was actually quite short-lived. That was the one during the pandemic, but I've only shown the ones which last more than 300 days, of which there are 3. The first episode was the European sovereign debt crisis and the US debt downgrade. That was in 2011, and that led to an equity sell-off of just under 20%. Then we had the Chinese yuan devaluation, which rocked markets globally, and that sell-off was slightly smaller, but quite long-lived. And then finally, most recently, we've had the spike in inflation and the Fed rate hikes, which have caused a big sell-off, which is ongoing. So if we look at the 5 LifeStrategy funds during the first episode of a sell-off, this is the one in 2011, and this was the one that was triggered by the European sovereign debt crisis, you can see that LifeStrategy 20, the one which has least equity in it, is hardly affected. There is a very slight fall here, but contrast that with LifeStrategy 100, which fell sharply and didn't recover for some time. It fell overall by 18%. So here, bonds worked extremely effectively as a hedge. Now let's turn to the 2015 episode due to the Chinese yuan devaluation. Again, LifeStrategy 20 only sold off by 4%, whereas LifeStrategy 100 fell by a huge 16%, 4 times as much. But this year, things are very different. If you look at which fund has fallen the most, it's not LifeStrategy 100, it's LifeStrategy 20, the one with least stocks in it. That's down by almost 15% compared to just 13% for LifeStrategy 100. And if we extend the period of time we look at to just as I make this video, that's in November, you can see that LifeStrategy 100 is only down 5%. It's almost completely recovered its fall, whereas LifeStrategy 20 is still down by 15%. So clearly something different is going on here. What is it? And you can see Vanguard is trying to do some damage limitation here. This is a quote from James Norton, who's head of financial planning at Vanguard UK. And he says, for a typical cautious portfolio with 80% bonds, that's LifeStrategy 20, the theory is that a fall of more than 12.5% should happen less than once in 100 years. But that's exactly what we've seen happen this year. Well, if you look at the components inside LifeStrategy 20, for example, here I've highlighted each of the bond funds which are all sterling hedged. Now in theory that should reduce the risk of the fund. Bonds are supposed to be safe, so you don't want to add additional currency risk, and so these funds are all sterling hedged. There's a derivative inside them which removes any currency volatility. But of course, one of the reasons why UK funds have done so well this year was because sterling devalued so much. That meant that any foreign holdings appeared to become more valuable when you convert them back to sterling. So the currency hedge actually hurt the bond holdings a lot over the course of this year. And just as with equity, Vanguard bond funds have a big overweight for the UK. So if we look at the UK holdings of bonds, you can see there's 12% here with UK government bonds, 8% with UK investment grade corporate bonds, and about 8% UK inflation-linked bonds. Now that's much more than you'd hold if you simply held according to the size of the UK market. Now over the course of this year, we've had a big increase in bond yields due to the whole fiasco around the mini budget. And whereas currency has recovered, yields really haven't. So both the currency hedge and the overweight for UK fixed income has hurt LifeStrategy 20, 40, 60 and 80. It really couldn't have been worse. So here's the key question. Have bonds stopped hedging equity? What I've done here is to show the return on the S&P 500, but only in years when it was negative. So small losses for the S&P 500 are on the right here, and large losses are on the left. And then on the y-axis, we have the return on US Treasuries. And again, this is a total return and it's a real return. We've adjusted for inflation. So in the top half here, you can see that Treasuries did their job as a hedge. They rallied at the same time as the S&P fell. Below the dashed red line is a fail as a hedge. Now you might think that the color of these boxes is actually the return on Treasuries. In fact, it's not. It's the level of inflation. Notice how when inflation's high, those are the years in which you get these really big fails for treasuries or bonds as a hedge. That's because inflation is kryptonite for bonds as well as equity, and the two fall together when inflation's very high. For example, look at 1917, inflation was above 18%, and both equity and bonds fell together. The same is true of 1946, 1941, 1974, and of course, 2022, when inflation is a fairly modest 6.6% currently. So that's why this time is different. It's because inflation's high, and that's why the hedge broke. And consequently, if inflation falls, I'd expect the hedge to start working again. So equity and bonds would decorrelate. Here you can see the value of PCE inflation, which is what the Federal Reserve looks like in the US, and the current level is 6.2%. It does seem to have peaked. And certainly if you look at the summary of economic projections from the FOMC, they're expecting that it's going to fall to 5.5% by the end of this year, then 3% by the end of next. So nowhere close to the 2% goal until the year after that, but still a big fall over the course of next year. Maybe they're too optimistic, but I think that they're probably right. And that's because many of the components we can already see for inflation in the US are starting to turn around. Energy, for example, or many of the supply bottlenecks. And this is from the Bank of England's November Monetary Policy Report. And again, they think inflation is going to peak at the end of 2022 and at the beginning of 23. But then over the course of the year, they expect it's going to fall sharply. Now, there are big error bands around that forecast, the central forecast, which is in the darkest color here. But the thing to remember is that inflation's a year-on-year measure. So prices have to carry on rising to keep it elevated. So I think it probably will come down next year, both in the US and elsewhere. And as a result, bonds will form a better hedge to equity. And this is why I don't think the 60-40 bond portfolio, the reasons behind it, have gone away. And never forget the base rates, in other words, the long-term returns from different asset classes. And this is based on returns looking back for over a century. In the US, equities returned almost 7% above inflation over that period. And this is a period that spans 2 pandemics, 2 world wars, and various other crises. Whereas bonds have only returned 2.1% above inflation. Now, immediately that tells you that if you are going to allocate for a long period of time, it's still the case that equity is where most of your money should be. Over a shorter period of time, you probably want the lower volatility of government bonds. And if you want to be super careful, you can always go for shorter duration government bond funds. But the price of that caution long term is a roughly 4.5% loss in return. So caution over the long term comes at a big expense. In conclusion then, if you're looking for a strategy which never loses money in any environment, you'll never find one. And just as with any other strategy, 60/40 has had an atrocious year, as have other two-fund portfolio approaches, which have global equity and global bonds, such as my portfolio. However, this was due to the very high inflation, and that won't persist forever. As inflation comes down, I'd expect equity and bonds to decorrelate, and the hedge will start working again. The second point is that base rates change very slowly. That's because they're taken over a very long period of time. So I wouldn't read into the huge loss in bonds this year as a trend that's going to last forever. It is a very exceptional year, and you should recognize it as such. So what I wouldn't do is assume that 2022 is the new normal, where equity and bonds are highly correlated, inflation's super high across the world, because that's not going to persist. This too shall pass. Now, I think many people have concluded, due to the events of this year, that bonds do not hedge stocks. However, I think that's a mistake. I think if you look back historically, periods of high inflation like the 1970s actually showed just the same behavior, with those big drawdowns. And these 60/40 portfolios seem to have a drawdown once a generation. And unfortunately, this has been that year. However, going forward, I expect that inflation will come down and the hedge will work again. Now, don't forget our offer from NordPass. If you want to manage your password safely online, it's a great way to do that. And you'll find more about that in the description below. And as always, thank you for listening.